The same $100 billion is being counted 3 times, and nobody is talking about it. The same capital appearing on 3 different balance sheets. This is not innovation. This is a magic trick, and a multi-trillion-dollar industry depends on it. The year is 2025, and we are living through the most hyped technological revolution since the internet. AI investment now consumes 1.3% of the entire US economy. That's a third more than the dot-com boom at its peak. OpenAI loses $11 billion a year. And yet, there is talk of an IPO at a $1 trillion valuation. How? How does a company losing $1 billion a month justify a valuation larger than the GDP of Indonesia? Sounds like a bubble, right? Let's rewind to the dot-com bubble. The market was drunk on potential. Valuations were detached from earnings. Companies with no revenue were going public at billion-dollar valuations. Back then, 36% of tech companies were unprofitable. Today, only 20%. This time, it's different, right? Not quite. The answer lies in 2 words: financial engineering. We've seen this strategy before. Remember America Online. 200,000 users in '93, 34 million by 2000. They merged with Time Warner in a deal worth almost $200 billion. It is now considered one of the greatest corporate failures in history. AOL built an empire on dial-up, and it worked until it didn't. They used financial engineering, paying partners to purchase AOL ads. OpenAI is playing the exact same game. This hidden structure is propping up this market, and it's called circular financing. Here's where it gets interesting. NVIDIA invests $100 billion into OpenAI. OpenAI uses that capital to buy compute from Oracle, who rents data centers filled with NVIDIA GPUs. The money never left the ecosystem. It's circular financing, and it's not illegal, but it's highly creative accounting. This is not isolated to NVIDIA and OpenAI. Microsoft invests in OpenAI. OpenAI buys Azure cloud services from Microsoft. Meta funds startups. Those startups buy Meta's Llama infrastructure. The entire AI economy is a series of circular dependencies. And we've seen this before. In the dot-com era, it was called vendor financing. Companies like Lucent gave customers loans to buy their products. When the loans defaulted, the illusion collapsed. Today, the mechanism is more sophisticated, but the risk is the same. Or is it? Here's where the story diverges. In 2000, the bubble was fueled by debt and speculative IPOs, unprofitable companies burning through investor cash. Today, the AI boom is funded by the strongest balance sheets in corporate history. Microsoft, Google, Amazon, these companies generate $60 to $70 billion in free cash flow per year. These aren't speculative bets. These are fortresses. Microsoft is building data centers the size of small cities. Google is rewiring the internet. Amazon is weaponizing AWS. This isn't the dot-com era. This is the infrastructure era. The foundation is stronger. But the stakes, they're astronomically higher. But forget big tech for a moment. Let's talk about what is happening on the ground. MIT surveyed 150 business leaders, 350 employees. 95% of companies saw zero return on investment from generative AI. Zero. People are saying things like, our accounts team spends more time fixing the AI's mistakes than they saved. The problem has a name: hallucinations. Large language models predict the next word. Statistically, they do not know truth from fiction. Even with that, companies are actively looking at integrating AI into their business. Cognizant, one of the world's largest professional services firms, just announced a substantial partnership with Anthropic to roll out Claude AI models across its 350,000 employee base. It looks like AI is here to stay. So let's zoom out. We have seen the circular financing, the enterprise failures, the global price war. Now the question everyone is asking, is this the dot-com bubble all over again? The comparison is obvious. Inflated valuations, unproven business models, speculative frenzy. But here is what they are missing. The dot-com bubble was funded by venture capital, by retail investors, by banks extending credit to unprofitable startups. The AI boom is funded by Microsoft, Google, Meta, Nvidia, and other big tech companies, the most profitable companies in history. They are not using borrowed money. They are using their own fortresses of cash. This is not speculation. This is strategic positioning. But there's a wild card no one is pricing in. What happens if big tech loses the AI battle? Remember DeepSeek? A Chinese AI startup that released a model that matches GPT-4 for a fraction of the cost. When DeepSeek's model dropped, Nvidia lost $589 billion in market cap in a single day. The biggest risk isn't the AI bubble, it's big tech losing the AI race. Because then all those trillion-dollar data centers, they're stranded assets. Just like the fiber optic cables of 2000. Revenue, and with it GDP, would collapse. So what happens next? There are three futures. Path 1, the technology delivers. OpenAI justifies its valuation. Enterprise adoption accelerates. Productivity explodes. We enter a new economic era. Path 2, controlled correction. Valuations deflate slowly. Adoption happens at a controlled rate. The market shakes out the weak players. And like the dot-com aftermath, a handful of giants emerge. The third path, catastrophic failure. But here is what history teaches us. Bubbles don't destroy technologies. They expose the difference between infrastructure and speculation. The railroads were real. The dot-com infrastructure was real. AI is real. The question isn't whether it will transform the economy. It already is. Productivity is rising. Real problems are being solved. The technology is getting better. The real question is, which path will happen and who will be left holding the bag? Of course, predicting the future is dangerous, but ignoring the present, that's more dangerous.